Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Amazon just reported earnings, and in my personal opinion, I thought the report was quite good, but there was one item, there was one very small detail, well, small relative to everything in the report itself, but there was one detail which I think has led to shares sliding as much as 10% in after hours. Currently, at the time of this recording, the stock is at roughly $200 per share, and so I'm going to explain all that and kind of cover the earnings in today's video. Additionally, both Uber and Google reported earnings yesterday, and we're going to cover that in today's video as a lot of you were asking for that. So without further ado, Amazon total revenues were up 14% year over year, and they actually reported their first ever $200 billion plus quarter. There was significant strength in the international markets, and additionally, AWS actually re-accelerated to 24% growth year on year. If we jump over to fiscal, we can actually see that this was their fastest growing quarter in over 13 quarters. You have to go all the way back to Q3 of 2022 to find a AWS quarter that was growing faster than this. So it seems like all their investments into AI CapEx is actually starting to pay off a little bit. This is similar to how Google reported, which again, we'll cover a little bit later in today's video. Operating income was quite strong. I believe they had roughly 11% operating margins within the quarter. The AWS segment alone brought in $12.5 billion of operating income. That it represents half of their total operating income within the quarter. Free cash flow was, of course, not that pretty. It did decrease to $11 billion over the trailing 12 months. Obviously, they are investing a bunch into AI CapEx, which is going to drag that number down. Additionally, a very fascinating insight was that their advertising business grew 22% year over year. I believe this was a slight reacceleration. They announced a bunch of partnerships and agreements with all of these different companies, which I'm not going to bother reading. And a super interesting development for them was that their Graviton chip, of course, Amazon makes their in-house sort of chips for their cloud business, which competes with the likes of the NVIDIA AI chips, has been adopted by 90% of their top 1,000 AWS customers. And additionally, they claim that this is up to 40% more price performant than the leading x86 chip. So again, you can just think of that as the leading NVIDIA chip at the moment. And so you might be looking through this and thinking to yourself, well, this seems like a solid report. They reaccelerated on AWS. The e-commerce segment seems to be doing fine. Advertising, they slightly reaccelerated. Operating margins hit an all-time high. Additionally, they're growing revenues at 15%, which in of itself is a reacceleration on the top line. Arya, why is the shares down? The reason for that is this tiny little line that they decided to include here. They said, we expect to invest about $200 billion in capital expenditures across Amazon in 2026 and anticipate long-term return on invested capital. So that's nice that they included that in there, that they're going to be expecting long-term return on investment. I hope, any entity putting $200 billion into anything expects some sort of a return. So that was nice, but we are kind of entering this environment where the market is a little bit spooked in terms of all this money that these big tech companies are dumping into capital expenditures. We had Google report yesterday. They vouched for roughly $180 billion. Amazon over the trailing 12 months has put $130 billion, and they just said they're going to be spending $200 billion. I obviously got on Twitter and joked that, at this point, this is a ransom payment to NVIDIA. We're basically funding the construction of the second moon at this point. Of course, shareholders are continuing to be slightly diluted to be able to fund something like this. It's only about, I believe, 1% or thereabouts. Yeah, 1.3% within this quarter. So it's not too bad in terms of dilution. There's significantly worse offenders out there. I think literally Oracle today is diluting by 2-3% or thereabouts. But nonetheless, I thought it was a very positive report. Shares are down, of course, on that sort of CapEx news. I continue to hold my shares. It is my top position at the moment. It accounts for roughly 26% of my portfolio. I'm personally not really looking to add more to my position. It already represents a significant allocation within my portfolio. And on a valuation basis, I don't find it to be particularly attractive. If you look at the popular price to operating cash flow, trades at about 18 times. We've had opportunities to be able to catch this business at a cheaper valuation than that, roughly in that 16, 17 times range. If you look at it on an EV to EBIT basis, I don't think it particularly trades that attractive relative to some other opportunities in the market today. 31, 32 times EV to EBIT. Of course, this is not adjusted for the drop after hour, so it is a little bit cheaper. But nonetheless, I don't find the business to be particularly attractive. I thought it was a positive development. Again, I'm going to be continuing to hold my shares, but I personally won't be adding. What I will be adding towards, though, is Uber, which also reported earnings yesterday. And by the way, if you want to see my live portfolio completely for free, super transparent, down to the millisecond in terms of the trades that I'll be making, you could do so over on Blossom. The link for that is going to be in the description down below. It's also pinned at the top of the comment section. Again, completely free to join, and you're able to track my live portfolio and what positions I'm buying as soon as they happen. Uber's report, on the other hand, was absolutely phenomenal. They were able to grow their revenues 20% year on year. This came off the back of a very strong print, both in terms of trips and gross bookings, which grew 22% year on year. Additionally, their operating margins expanded, and actually, funny enough, they now have higher operating margins than Amazon. For the full year, their operating margins were about 11%, but particularly within this quarter, operating margins climbed to 12.3%. And additionally, another fascinating KPI that I found was very indicative of the strength of this platform and the continued growth for many, many years is their monthly active users. Now, Uber doesn't break out like monthly active users by app, because of course, they have the delivery app, they have the core mobility app as well, but they kind of give us this KPI, monthly active platform consumers, which is essentially if you have both the Uber Eats app and you have the Uber mobility app, you count as one person. The growth on that re-accelerated to 18% year on year. And for the first time ever, they now have 200 million monthly active users across their platform. A very, very strong report. Additionally, they blessed us with a lot more clarity in terms of their investor slide deck that they share, the supplementary slides that they include in there. One of the big fears with Uber has, of course, been the autonomous vehicles. They gave us some color in terms of how some of these markets are being impacted once autonomous vehicles are implemented. Particularly with Austin and Atlanta, it seems that the TAM expansion thesis is continuing to play out. So there's this argument that's been made that even in the event of a new competitor arising, such as a Waymo, a Tesla, whatever the case is, the overall pie continues to grow. The overall number of rides continues to grow, and Uber is able to capture that. And in fact, this is starting to play out. We're starting to see that, particularly with Austin and Atlanta, the number of first-time riders is accelerating and it's growing faster than the rest of the United States. Additionally, the number of trips per rider is growing slightly as well. They're seeing an acceleration in terms of growth in the markets that autonomous vehicles are implemented, which supports the idea that the overall pie for rides is going to continue to grow. Another fascinating slide that they included in here, this really speaks to the network effect business that Uber has built over the past 2 decades. They're noting that the autonomous vehicle partners that are listing on the Uber app have 30% higher average revenue per day as opposed to the AV companies that are not listing on Uber. And then additionally, on the consumer side of things, there's a 25% faster ETA for AVs that are being purchased on the Uber platform as opposed to AVs and rides that are going outside of the Uber platform. So this really speaks to the network effect of the business, where both for the AV partners and for the consumers, it's more advantageous. It's a better service overall, whether it's through generating higher revenues or whether it's through getting faster ETAs and cheaper rides. It's good for both the consumers and good for both the autonomous vehicle partners, really speaking to that network effect that they've built and the value that they're adding for both consumers and AV partners. Speaking of AV partners, they outright said that they intend to be the largest facilitator of AV trips in the world by 2029. These are all the different cities that they're currently live in. These are the upcoming cities, I believe, this year. And then additionally, all the partners that they have across the board in terms of the hardware companies, whether that's a Volkswagen, a Lucid, whatever the case is, the self-driving technology companies that they're partnered up with, and additionally the fleet management, which is something that is very rarely mentioned when it comes to the total cost that is incorporated within these autonomous vehicles, independent of an Uber. Overall, I would rate this a 10 out of 10 report. They accelerated on the top line. They grew in terms of monthly active users. They reiterated the fact that they're going to be surviving and actually thriving in the world of autonomous vehicles, and that they're the de facto platform when it comes to be able to carry out these AV rides. And then lastly, in terms of the Google report, this was primarily a cloud quarter. Google's cloud revenues re-accelerated to 48% growth year on year. I believe part of this was acquisition driven because they bought that cybersecurity company recently, but nonetheless, a very positive development. If you look at the cloud operating margins, those also expanded this quarter. It went to 30%. And if you take a look at the same quarter last year, it was just at 17%. So a massive growth in terms of the margins on that business, on top of very strong top line growth. Google search continues to be very strong at 17%. And the only sort of like negative that I could find within the report was YouTube ads revenue only grew 8%. That is a pretty significant drop off in terms of the growth rate last year. But what you're seeing with YouTube here, and something that they included in the report, YouTube is no longer just an ads business. For the first time ever, they told us directly that $20 billion of revenues came from the YouTube Premium, the YouTube subscription that people are buying. That accounts for roughly 1/3 of the total revenues that business is generating. Now, they don't actually directly break out the subscriptions that they make from YouTube, but the overall Google subscription and devices revenue came out to roughly $50 billion to close out the year, and that was up 19% compared to the trailing 12 months prior to that. But shares of this business were also down slightly over those sort of capex guides of roughly $185 billion. Overall, I would give Google a very solid rating in terms of their report. Across the board, they came out very strong, whether it's search, whether it's Google Cloud, the growth on that, the margins on that. YouTube ads revenue, again, a little bit weak, but it's kind of offset in terms of the subscription revenues that they're generating. Before we end off the video here, I did want to also talk about Snapchat, which congratulations to any shareholders, if there's any of you remaining. They put up their first ever profitable quarter. It is only $50 million, so it's a drop in the bucket in terms of how much profits they generated, but nonetheless, very positive development. It was their first ever profitable quarter as a public company. They've been public since, I think, 2017. If you might recall, we did a video about them called This Piece of Shit Has 10x Potential a couple months back, and I think they are starting to kind of flex their operating leverage on that side of the business as they transition to a sort of subscription, iCloud style cloud storage, making revenues off of storing your memories, your photos and videos on the platform. Definitely a very interesting investment. I personally don't have a position or any ambitions of opening a position, but nonetheless, something fun to track over the next handful of quarters. With that being said, thank you very much for watching. Be sure to track my portfolio live with the Blossom link in the description down below. And other than that, have a great day.